I do want to start off with the current situation, the collapse of 3 banks here in the U.S. and a couple others that, quite frankly, are still teetering on the edge, and a lot of questions as to why there wasn't a little bit more scrutiny, whether from regulators or from investors, as to what was going on behind the scenes.
It's interesting because in hindsight, and to be clear, we were not looking at the banks. We, as activist short sellers, generally focus on companies where there's at least some level of misleading investors, if not outright fraud. But when you look back in hindsight, these problems were there in plain sight with the disclosures about the losses on the held-to-maturity securities. So obviously what's happened is you've had the Fed hiking interest rates quite quickly, and you've had a lack of risk management by many of these banks. Now, what I think this speaks to, and this has been the bane of short sellers since the global financial crisis, is all of the leverage that has been created and all the money that's been pumped into the financial markets in order to just keep the system going and perpetuating the markets, and what they call the Fed put.
Yeah.
And so this is the cost of it. You create fragility in the system, and the crazy thing about this is that, these risks were right under the noses of the Federal Reserve Board of Governors and FOMC committee members. This wasn't something that was far afield where, in hindsight, you'd say, well, that would have been hard for them to foresee.
Right.
So that's the problem when you create these bigger and bigger powder kegs of leverage and you base your economic policy on leverage. So that's what this is a function of.
Well, when we talk about the Fed put, or whatever we want to call it, we've lived with this, at least here in the U.S. now, basically since the global financial crisis. There are a lot of people that saying that the Fed put, or at least a government put of some sort, is basically back. Does that complicate things for people like you?
I think this complicates things for everybody. So if we look at what happened with Silicon Valley Bank, and Signature, the depositors got bailed out. Now, obviously, we want to have a robust regional and community banking system. That is in our economic interest. But when you bailed out these depositors, and I get that the depositors, they didn't think they were taking a ton of risk, and there's a very valid conversation that we could have about what the deposit limits should be at these banks. But when you walked into the lobby and it said accounts insured up to $250,000, and then all of a sudden it's like, no, you know what? We're gonna move the goalposts again, and we're doing it to protect people. This is a perpetuation of the infantilization of financial markets that has occurred going back, I would say, at least until the internet bubble, or at least since the internet bubble popped. And again, what you're doing to cushion the blow is you're just using more leverage to do it, and you're encouraging taking of worse risks.
Yeah.
So,
but if you don't cushion that blow, though, Carson, what's the consequence of that? Does the consequence of not cushioning the blow, is that much greater than whatever moral hazard you create by continuing to bail out folks?
So without being an expert in the statutory framework around this, my view at the time was that the depositors at Silicon Valley Bank and Signature Bank should have taken haircuts. Now, at the end of the day, there were bids of 70 cents for their claims, so it would have been a 30% haircut if they wanted immediate liquidity. If they held on to their claims, they probably would have ultimately taken 10 to 20 cent haircuts. And when you look at Silicon Valley Bank, to me, this ended up being not just a bailout of the depositors, but it was really a bailout of venture capital funds. Because Silicon Valley Bank was particularly, I think, from a moral hazard perspective, egregious in that they deliberately, and when I say they, it's the bank and the VC funds, they deliberately created this very closed ecosystem where everybody put their deposits there, then they borrowed, they took out loans, they took the free cash, they redeposited, it was reloaned, and it's all within the same circle. And really, if companies there, the uninsured depositors, they were almost entirely venture-funded companies, if they'd been forced to take some haircuts, then basically, and that hurt their operating cash. Well, these VC funds that say, hey, we have all this dry powder, well, they would have been forced to re-up and recapitalize these companies to some extent. But what ended up happening was, effectively, the U.S. government came in, and because believe me, there were a number of companies that the VCs would not have re-upped their investments in, given the change in the macro environment. So these companies that are at this point uninvestable for venture capital funds to re-up, the U.S. government just ended up basically putting money into them and getting nothing in return. So to me, you should have let the depositors at these banks take haircuts, but then say, okay, from now on, okay, risk has been realized. From now on, we're going to create this program where we're going to lend at par against securities, and your deposits are protected. So somebody has to take losses at some point if we're going to eliminate this cycle of people taking really bad risks with other people's money and then getting, and then basically the slate getting wiped clean. Like this just leads to worse and worse outcomes over time.
This, of course, there will be a long history of investigation and litigation, of course, that follows all this. I am curious, Carson, I do want to pivot just a bit here and to talk about some of your colleagues in the space, particularly when it comes to Nathan Anderson and what he's been doing over at Hindenburg. Of course, his report on Adani really shocked a lot of people, and a new report out today regarding Block, the company formerly known as Square. Are you familiar with this research? Are you familiar with him?
Yeah, no, I'm familiar with Hindenburg. I know the principal, Nate Anderson. I think very highly of him and his team and the work that they do.
Do you think that the types of strategies that he employs, and strategy that you've employed in the past to much success, do you think that's still a viable strategy in a market where you do have, I guess, for lack of a better word, a backstop by the government that says if things get bad, we're going to be there?
Yeah, it's funny when you look at activist short selling, which, if the universe of good shortable stocks is this big, activist, good activist shorts is maybe this big relative to that, so it's a fraction of it. Actually, last year was probably the worst year in terms of the alpha generated by activist shorts, and it was still a considerable amount of alpha, but it was probably the worst year since the global financial crisis. And activist short selling didn't really exist much prior to the GFC. But that would surprise people because it's a year in which the S&P 500 declined. There's a significant correction, and so people assumed that activist shorts were having this fantastic year, and that wasn't necessarily the case. So in terms of the environment, I mean, really, with activist short selling, you're in a way betting against human nature because this business model thrives when there are people who take advantage of investors' trust in the markets. And there will always be people who come to the capital markets to do it. I mean, probably the one environment in which activist short selling probably would not have been a good idea would have been March 2009. But absent that, even with the Fed put, I mean, look, every year between 2010 when I started doing this and the beginning of 2020, the investors became more and more anesthetized to risk. So the bar for telling, for coming up with stories, basically, to use a media analogy, that investors would care about got higher every year. But the thing is, as market caps inflated, in line with the investors being inured to risk, what happened was the most egregious behaviors that previously had been confined just to the bottom rung of market caps, well, those ended up getting bigger and going into the mid-cap spaces with some frequency. So I feel like there's, as market caps shrink now, as investors take losses, they're also more averse to risk. So for activist short selling, I think it's always a pretty good time, at least until computers and GPT-11 automates our jobs away. But until then, I think it's a reasonable space to be in.
Well, Carson, that's a risk for all of us. But before we get there, I do want to talk a little bit more about the climate for short selling right now, because like you said, it is a good time to do that. But talk to us a little bit about the reception, because you think about what happened with Melvin Capital after what happened with the Reddit phenomenon, whatever you want to call it. You think about what happened with Andrew Leff of Citron Research having to delete all of his old tweets. It feels like when you come out with some of these big, splashy predictions that it's been subject more so to a lot more scrutiny than perhaps in the past. What are your thoughts on that?
Well, I mean, obviously, when COVID hit, there were a lot of retail flooded into the market, and there was more vitriol directed at especially activist short sellers. But I like Andrew a lot, and I hope he'll understand when I say this that 35-year-old Andrew Leff would not have deleted those tweets. 55, give or take, year old Andrew Leff, life's too short. I understand it, but I think that when you look at the activist short sellers especially have relatively short half-life because of the intensity of this business. So I wouldn't look at that as a harbinger of things having changed. But there are always, I actually, the FT published an op-ed of mine this morning, coincidentally, on activist short selling regulation. And it's just so funny seeing the comments. Almost everybody is spewing venom and, naked short selling and it's creation of synthetic shares. And people say these things all the time without proof. And that's when it comes to short selling. But people are allowed to be very emotive, or emotional in their commentary without any factual basis.
Right, but that's not new. As long as short selling has existed, this is always, that type of backlash has always been there. You talk about Andrew Leff and maybe what he would have done in his 30s as opposed to his 50s. What does a Carson Block at 45 do? Do you still have the gut and the temerity to continue taking that type of, and it's not just abuse. In fairness to Leff, he was very clear that this was also about lawsuits, litigation, that he just didn't want to have to deal with anymore.
But again, 35-year-old Andrew doesn't care, right? I sat down with Andrew one time a few years ago. The first time I got sued, so this was probably 11, 12 years ago. And it was the day that I got sued, and I was complaining about it. And Andrew looked at me, and he goes, "You know how much money I've made as a defendant over the years?" Using his using countersuits. I was like, "I don't know how much." He's like, blah $1 million. Like, it was a number. And that's like, that was the tenacity where I was like, wow, how do you do it? He's like, oh, these companies want to drop the suits, but I don't let them drop. Like, I keep my suit against them for defamation in play. And so, look, how long do I have in this business? I think some number of years, but when you say that, older than I am.
Yeah, but when you say that some number, are you talking about as a dedicated short, or is it like a mixture of long, short? What are you doing now?
The core business is activist short selling. Okay. We do have an office in Vietnam that we opened 1.5 years ago, and we expect to be doing outside of our core strategies. We do expect to be doing long-oriented investing in Vietnam, and we've done some stuff in mining that I think we can expand upon. But yeah, my focus is primarily going to be on activist short selling, as it has been. Now, maybe there will come a time when I'm just, it's too much drama. Look, it's a decent living, but per unit of brain damage, it's definitely one of the worst businesses in the asset management industry. But I do it probably because of personality flaws versus I think it's the best business ever.
Well, Carson, to that point, do you see short sellers going underground? With the exception of people such as yourself who can sort of are up to handle the heat. Do you think that sort of breed of investor is maybe going away?
Well, following GameStop, a lot of long-short managers stopped shorting single name, or they stopped doing single name shorts. And I think but ironically, of course, GameStop was really the top tick of the market for the real garbage companies. So, look, I think that there are ebbs and flows to these things, and long-short funds are getting back into single-name shorts. Now, the one thing is when you're a fund manager and you're running and you run a real short book is, your clients, like the big allocators of the world, they always, it's like, they always want to leave through the back door. Like they want some level of discretion about being invested with somebody who's a short seller. Now, We don't have that problem because we're very upfront about who we are, and
Right.
we'll never get money from the Saudi sovereign wealth fund. I mean, part of that's because I like to insult, the Saudi government, regularly on social media too. But I think for your traditional short sellers, they're generally going to be discreet about things and continue to be, because it's just the market for for allocators. They want to keep it on the down low.